That's us now, William.
Good evening, everyone, and welcome to our post-budget information webinar. I'm told that there's over 500 on tonight, so this has definitely generated a lot of interest, and we have an excellent panel here to inform and advise you as we go through. The panelists are in no particular order. We have Des Kelly, who's the regional head for Northern Ireland of Cooper Parry Accountants. Des brings a lifetime of experience to helping clients overcome challenges with practical, tailored solutions across audit, tax, and business advisory. He has particular interest in farmers and agri-businesses that are navigating complex financial and tax issues. Next, we have Kathy Blair, also a tax director within Cooper Parry. Kathy has over 23 years of experience helping individuals, families, and business owners to navigate the complex UK tax rules. Her expertise spans inheritance tax and capital gains tax planning, including advising on family trusts. And then the third panelist is Peter Brown, a solicitor with Martin King and French and Ingram. Peter Brown is a solicitor in Limavady in Northern Ireland and has been the Northern Ireland regional organiser for the Agricultural Law Association since the branch was formed in 2016. And he was co-opted onto the Agricultural Law Association Council shortly afterwards. Peter has also delivered farm succession presentations over the last 15 years for STEP, Rural Support, ourselves and Ulster Farmers Union, and numerous other agencies. So we have then, and the fourth one is Sean McCann, a chartered financial planner with NFU Mutual. Sean has 30 years experience advising farmers and business owners on inheritance tax, pension planning, and Sean's advice is regularly featured on national media, including The Times, The Telegraph, and The Mail. And last, but by no means least, we have our own Alexander Kinnear, who's going to bring a political aspect to this. Alexander is our parliamentary officer within the union structure. So to the panel, I welcome you all here, and I hope you're fully awake and ready for all these questions and discussions that we're about to have. Just some housekeeping. The webinar will be recorded, and people who have registered will be able to watch it back afterwards. And anyone that wants to ask a question, they can, at any stage through the webinar, you can put a question in the Q&A box, which we will answer. We'll address the questions at the end, or the whole panel will address the questions at the end. So just before we head into the webinar, I just want to sort of update you what all has happened from a union point of view since the budget of 2024. Shortly after that budget, when we were all basically stunned with what the Labour Party had, the proposals they had announced, we had our mass rally at the Econ Centre, which broke all records for mass rallies within the union organisation. We had tractor runs across Northern Ireland and across the UK. But probably equally, if not more significant than that, we had endless trips to Westminster to lobby MPs and Lords. And that has continued right up until the present day. And one of our staff members is, as we speak, is in the House of Commons tonight. And just by coincidence, there is a debate under the budget in the House of Commons tonight. And unusually, they're taking a vote on the individual issue of agricultural property relief. So at the end of our questions or our agenda here, we will bring in Alexander to update us on what way that has played out within the House of Commons to date. It's an unreal moment, the Labour Party, it has to be said, seems to be in a certain amount of chaos at the minute. The budget of last week was all about filling the black hole, which now turns out not to exist. And there's a lot of frustration. It has increased the anger and frustration, I feel, among our members about the unjust treatment that is facing the whole farming community. So that's enough for me for now. I'm going to move straight on into the agenda, and the first item we're going to talk about tonight is the inheritance tax one. And Sean from NFU Mutual is going to just set the scene for that with a few short slides, and then we'll give everybody a chance to speak and see where the discussion goes. So, Sean, if you want to start off with your slides.
Yeah, thanks, William. Ruth, if you could move the slide on, please.
Yep.
And probably the next one, if you go to the next one.
There may be a very slight delay on the slides, just so the panelists are aware.
That's absolutely fine. Thank you. So, yeah, I mean, given the impact these proposals are likely to have on the farming community, we thought it'd be good to give you an overview of how the proposals are intended to work, and also the change that we heard about last Wednesday. So we'll cover that. So we'll go back to first principles of what inheritance tax is. Basically, in its most simple form, it's a tax on what we leave behind when we die. Because when someone dies, the family have got to make a return to the revenue and list all of their worldwide assets. And when I say all, I do mean all. So cash, property, investments, they all go on that return. Ruth, if we can move on, next slide, please. So anything you leave to your spouse or civil partner is completely exempt without limit. And we all have a tax-free allowance of £325,000. And if that isn't used, that's available to your spouse. So as an example, if I die and leave everything to my wife, there's no inheritance tax between us. And what happens on her death is she's got her £325,000 tax-free plus mine. It's transferable between us. Okay, next slide, please, Ruth. Okay, so there's also an extra allowance that's available to some people, and it's worth £175,000 per person, and it can be used against the value of your home, provided you leave your home to a direct descendant, and that is children, grandchildren, stepchildren, foster children, or adopted children. If you leave it to a niece or nephew, you don't get it. If you leave your home to a sibling, you don't get it. It's only if you leave it to a direct descendant. Now, again, I say this allowance is only available to some people. If the value of all your estate, so that's everything you leave behind less any borrowings, is worth more than £2 million, that starts to get eroded. And every £2 over 2 million, you lose £1 of the allowance. So if I leave an estate worth 2.35 million, I don't get this. Okay, that's why we say it's only available to some people. And again, if I do qualify for this and I don't use it, so I leave my share of my home to my wife on my death, she gets to potentially use it on her death. So she's got two lots of 325,000 tax-free, plus potentially another 350,000 to use against the value of the home. And if you add all that together, that's £1 million that's potentially available, tax-free. Okay, Ruth, if you could move on to the next one, please. Now, obviously, many of you will be familiar with this. There's pretty valuable reliefs available to farmers and landowners called agricultural property relief. And this has been around for many years, and it's designed to protect farms when they're handed down through the generations. The reason being is that if you levy inheritance tax every time a farmer dies, what that can often result in is the land having to be sold in order to pay the tax. And that leads to smaller, less efficient units. So that's the reason agricultural property relief was brought in. So if you're a farmer and you've owned and farmed your farm for at least 2 years, and you're still farming at the time of your death, you would normally expect to get 100% agricultural property relief currently. And what that means is the agricultural value of that land and those buildings is exempt from inheritance tax without limit currently as we sit here today. Ruth, if you could just move to the next slide, please. Now, even if you don't farm your own farm, if you have farmland that you rent out, okay, provided you've owned that agricultural property for at least 7 years, and throughout that period, it's been used for agricultural purposes, so it's been farmed by you or somebody else, and you have the right to vacant possession within 24 months, or you've got a tenancy granted since the 1st of September 1995, again, you can qualify for 100% agricultural property relief. And obviously the system you have over there, Colnacre, that qualifies potentially. If you've owned that land for at least 7 years, you can normally get 100% agricultural property relief on it. Okay, Ruth, if you could just move on, please. Now, a couple of things just to be conscious of is that there was a rule change in April last year, and agricultural property relief is only available on agricultural land in the UK. So anyone in Northern Ireland perhaps owns land over the border, agricultural property relief does not apply to land outside the UK. If you're farming it, you can potentially get what's called business property relief, but I'll talk about that a bit more in a moment. So that's one thing to look out for. The other thing that changed in April this year is that I know agriculture is a devolved responsibility, but over here, a lot of farmers have been encouraged to turn their land over for environmental use. A lot of them are holding off signing up to those agreements because they thought, well, if it's not been farmed, they won't get agricultural property relief on it. But the government changed the rules in April last year in that if the land is managed under an agricultural agreement, it still qualifies for the relief. So that's just a couple of wrinkles just to be conscious of. Can we have the next slide, please, Ruth? Okay, so I mentioned business property relief earlier. Now, in the same way, agricultural property relief is designed to protect farmland and buildings from inheritance tax, business property relief is designed to protect trading businesses. Because if you run a trading business for at least 2 years, again, you can normally qualify for business property relief. But it's really important just to draw a distinction between trading businesses that qualify for the relief and investment businesses that don't. I'll give you a very quick example of this because I know a lot of farmers over in Northern Ireland have diversified for lots of different reasons. If I've diversified and I run a garage business on the side, let's say, or I just run a garage business, I've run it for at least 2 years. I own the building and all the kit in the garage, all the machinery. I run it for 2 years. If I die, my family would normally get 100% business property relief, meaning it would be exempt from inheritance tax. But if, on the other hand, I had 10 buy-to-let properties and I let them all out and picked up rent, that's deemed to be an investment business that gives passive rental income. So there's no business property relief on that. So it's just one to be aware of. And business property relief is very important to working farmers as well, because they claim business property relief on their machinery and their stock and other things. So it's one to go. And currently that's unlimited as well. Can we have the next slide, please, Ruth? Now, obviously the news you'll all be familiar with that was announced in last year's budget is that from April next year, so we're only 5 months away from this, the amount of agricultural and business property relief you can claim at 100% is capped at £1 million per person. Any qualifying assets above that will only qualify for 50% relief. And what that means is half the value will be tax-free and the other half will be taxable. But it's really important to realise this relief is per person, not per farm or business. Now, the good news that was in the budget last Wednesday was that the original proposals by the government said that this £1 million allowance, if you don't use it on your death, your spouse doesn't get it. Or if you're a widow or a widower and you lost your spouse many years ago, you don't get it. Well, the government at least did see sense on this, and they've agreed that it can be transferred between spouses or civil partners no matter when the first spouse died. So it is available to widows or widowers. It's really important to say It isn't available. It can't be transferred between unmarried couples. It's either spouses or civil partners. If you could just move on slide, please, Ruth. Okay, so I'm just going to give you a quick example here just to show you the impact. Okay, so this is Peter. Peter's a widower. Now I've upped these land values because your land is a lot more expensive than it is over here. So 200 acres worth about £3 million. That's maybe a little bit conservative. I don't know. You can see machinery in stock 400,000, farmhouse and building 600. He's got a total of 4 million. If something happened to Peter today, that would all be free of inheritance tax. Ruth, if you can move on to the next slide, please. But when we get past April next year, same scenario. If Peter dies, the first £1 million tax-free, and Peter can also claim his late wife's £1 million as well. So he can leave £2 million tax-free. The £2 million that's left, he gets 50% relief on. So what that means is half of it's tax-free and the other half is taxable. So that leaves £1 million taxable less 2 lots of 325, because Peter's widow left everything to him. He can use his 325 and hers. That's 650 tax-free. And what's left is taxed at 40%. So that's a bill of £140,000, where today there isn't one. If you could just move on to the next slide, please, Ruth. Now, when it comes to paying inheritance tax, it's normally got to be paid within 6 months of the end of the month in which death occurs. Okay, but there are provisions to pay it in 10 annual equal instalments. And you can pay it in annual instalments on residential property, but you do pay interest. And that interest is at 4% above base, Bank of England base rate. That gives you a payable rate today of 8% a year. But if it's agricultural land and buildings or qualifying business assets that qualify for business property relief, you can pay it in 10 annual equal instalments free of interest. So that's important to know that. Okay, Ruth, if we could move on to the next one, please. Okay. Is that moving, Ruth?
We've lost her.
We've lost it.
Yeah,
Drop up there.
it's coming again now, maybe.
Okay.
I will just take over here.
Okay.
Sorry about this, folks. It's the Wi-Fi is letting us down.
So where were we?
Yeah, keep going, Dan, keep going. Oh.
No, okay, there we go. We're back. We're back. 2 seconds.
Okay,
No.
brilliant. Yeah, thanks, Daniel. That's brilliant. Thank you. So obviously taking advice, obviously everyone's situation is completely different. So a couple of things on the advice. Obviously, you can choose to protect liability if you want. And one way of doing that is to take out what's called a whole of life insurance policy, because that will pay out when the individual dies. Whether they die 85 or 105, it's paid out. And we also recommend that's written in trust, because if you write your life insurance policies in trust, what that does is take it away from your estate for inheritance tax. If any of you have got any life insurance policies already, make sure you get get them checked to make sure they're in trust. If they're not, they'll come back to your estate and be subject to inheritance tax. So we always make sure they're in trust. So this slide just shows you what it costs for £100,000 worth of whole life cover. I won't bore you by reading it out. You can see the older you get, the more expensive it is. But these are based on a non-smoker. If you smoke and things, obviously it's more. But those premiums and that level of cover, whatever you go for, are set at outset. And the premium doesn't increase in order to cover. Anyway, if you can move on, next slide, please, Dan. Okay, the other thing, the other option, main option, I'm sure the panel will have lots of views on this. One way to get around it is, if you're able to, is to look at gifting assets. And if you live 7 years, normally that's exempt from inheritance tax. But there's a few things to look at, and I'll just take the bottom one first. It's called gifters reservation. If you're giving assets away, you can't continue to benefit from them. So as an example, if you were farming and you brought a son, daughter into the partnership and gave them a share of the assets, that needs to be reflected in the profit share, because you can't be seen to be benefiting from that gift that you've made. But I'm sure Des and Kathy will have a view on that as well. So that's gifts with reservation. If you're going to give it away, you can't continue to benefit from it. When you gift something, it can trigger a capital gains tax charge. But if you're gifting agricultural land or other assets that qualify for qualifying business assets, you can claim a relief called holdover relief, which I won't bore you with now, but it basically kicks the liability down the road. So you don't actually pay any capital gains tax at that point. And if you're going to do that, one option you've got as well is to protect the liability with a term insurance for 7 years. And this is just a life insurance policy. If you die within 7 years, it pays out. It helps pay the inheritance tax bill. If you don't die, there's nothing back. It's pure insurance. And Dan, if you move on to the next slide, you'll see that's the cost of that. That's a lot cheaper than the whole of life, because obviously we hope and you hope we're not paying that out. We're not paying this one out. The whole of life we will pay out one day. But here you can see, it's a lot cheaper. Even a 60-year-old, it's less than £30 a month in standard rates. Okay, Dan, if you could move to the next slide, please. Okay, just skip that one, Dan. I think we've covered that. Okay, we could move that one.
Can you move?
Brilliant. Yeah. Okay. So, and obviously, we've got a lot of farming families out there where it's just way too early to consider gifting anything. Particularly, we've got a young family. What we'd say there is just take out a term insurance that basically buys you time. So, young family here, we'd be saying probably, take out a 25-year term insurance just so that God forbid if anything happens, there's money there to pay the tax to help protect the farm. So that's one to look at. And I think that might be, do you want to move on to the next one, Dan? Yeah, so that's a quick canter through basically the principles of how these new rules are going to work.
Yeah, no, that's a very good overview, and thank you for that sort of initial scene setting on that, Sean. So in this new, for the benefit of this discussion, we're assuming that come the April next year, the Chancellor will get her way. So one of the things that was mentioned there, and I'd like to put it to Des and Kathy, is the gift with reservation, because I feel that sort of applies to a lot of farm situations. Des, do you want to lead off on that one?
I can do, William, and good evening, everybody. Certainly, in the wider context, I don't think we've ever been busier dealing with succession in both businesses and in the agri sector has always been a relatively simple thing because of the 100% relief both for business and agriculture property. But the changes have been absolutely huge, and we've been just flat out all the time dealing with this. But it's a very difficult one, and it's very practical. In relation to the specifics of the gifts of reservation of benefit, that principle actually applies to all assets, not just agricultural assets. So the theory of the thing in terms of people thinking that they can gift something, whether that's their home or whether that's their business asset or agricultural asset, and continue to benefit from it effectively is the piece. So if you have land that you give to a son or daughter who's not actively in the farming business, and you continue to farm that land and don't pay a commercial value for the use of the land, then technically you're exposing yourself to a failed gift effectively. And if you have a failed gift, you've really not achieved anything by doing it in the first place. Kathy, if you want to chip in on that to back that up.
I think that's a good summary, Des. Pretty much if you continue to benefit from an asset that you've gifted and not paid a rent or some sort of charge for the use of that asset, then it will still form part of your estate. and as you say, you haven't achieved anything. As you mentioned there, Des, we have never been busier. There's not enough hours in the day, I suppose, some days. But just in summary of what Sean has set out there very clearly for everyone, even though there are only a couple of bullet points on each slide, there's just so much depth to each piece. Sean, you mentioned there just, lifetime gifts, for example. In a lot of scenarios, that's great if you can easily identify a successor, someone that's going to or willing to come on board and help out. So each family and everyone's circumstances are very different, and that's where we find, just as a starting point, some of the people on the call today will have companies, some will have partnerships, some will have sole trades, and there's a separate set of rules around all of those different I suppose structures. So as a starting point for everyone, it's really important, and this sounds extremely simplistic, but to sit down and look at what you actually own and put an extremely realistic valuation on each of the assets you have. And I suppose, listen to certain headlines around the likes of farmhouses you mentioned there, Sean. It's not always safe to assume that you're going to get relief on the likes of a farmhouse. It's something Des and I spoke on recently. There's a bar to be met there to be able to qualify for relief on assets such as farmhouses. So there's plenty of opportunities for planning. We didn't get the news that we had hoped for last week, but as you mentioned there, Sean, throughout your slides, it's key to think about what you can do now. And a very simple level, when we do talk about lifetime gifts, yes, you have your gift with reservation of benefit angle that we've just talked about, but you also need to look at your capital gains tax implications, your stamp duty land tax implications. So as Des mentioned there, wind the clock back, very effective planning was just hold an asset until death. You then get a capital gains tax uplift in the value, and you would have got your 100% APR or BPR reliefs. So yes, lifetime gifting now will be an option for many people, but then you need to look at the capital gains tax implication of doing that as well, and what that means. You touched on holdover reliefs, and you could probably do a session in that in itself, but claiming that holdover relief means you don't get that uplift. So although your slides seem simple there, Sean, there's a lot in it, and I'm sure you're having a lot of conversations in the same space.
Yeah, absolutely, Kathy. And one of the things that I'm sure it happens over there, we've had recent cases where someone's they don't have planning permission on land or whatever, but the revenue have put what they call hope value on land where it's got potential building, and I've put some quite inflated values on land where there's potential development on it, and it's been left to the family then to argue about what that's actually worth, because obviously the revenues market values, and that's what they can sometimes, even if someone doesn't have development or planning permission on land, they can put hope value on it. So I think you talked there, Kathy, about putting realistic values on things. That's really important in my experience.
Has to be your starting point, to show what your exposure is likely to be, and that will form any discussion that then you have with your accountant, your solicitor, or whoever it is you're having that conversation with. If you're not realistic, the outcome and the planning you put in place won't work, or it won't achieve what you're hoping for it to achieve.
I think, Peter, if you want to come in now and put the legal perspective on this discussion.
Yeah, just to endorse what's already been said about gifts with reservation. James McCluggage was at the STEP conference a couple of weeks ago, and whenever Rural Support took over the Farming for Generations talk, they asked me what I thought we should talk about, and it's gift with reservation. And there are a number of examples, even in the inheritance tax manual, that if you give away farming assets like land, it has to be reflected in how the farm income is divided, and so on and so forth. The classic quote from a judge from a case from a number of years ago is that if you give away the cake and you keep or you eat more than a few crumbs, the revenue is allowed to treat you as having eaten the whole cake. So even if you've given things away, you need to keep that under review You need to be talking to your professional advisors about what you pay for the privilege of potentially renting your own land back and so on and so forth. But that is the one thing actually that concerns me about this, is that people will give things away and think that they've drawn a line under this problem and it's finished, and it's not. Even in residential settings this week, prior to the budget, we have done 2 people who have given away their house. They're renting it back from their children, and they have to review that rent virtually every year to make sure that that gift continues to work.
Thanks for that, Peter. Before we move on to the next item, which is inheritance tax, anyone with any last comments around sorry, we're moving on to income tax. Any last comments on the inheritance tax?
I wouldn't mind coming in, William.
Yeah.
It's such a personal thing, if you know what I mean, and it's such a big thing for families to decide. And as Kathy says about having a successor, that's a big thing. First of all, that you actually have someone who's capable of coming in and working with you. The next thing then is, and Peter will know this, then you need to protect. Because if you want to engage in doing the right thing in terms of dealing with natural succession and bringing your successor in, you still need to look at how you protect those assets, and how you can either have a shareholders agreement or a partnership agreement or suitable protections, so as that if there's matrimonial issues or any other problems down the line, that we don't end up in a worse situation than having to pay inheritance tax. So it's a complex thing, and it needs joined up thinking right across from your accountant, your solicitor, and your insurer, whether that's with UFU or who that's with. Those 3 legs of the stool are very important in getting an outcome that works for you as a farmer.
Thanks for that, Desi. That's a very complete summary of where we're at. I just remind all our listeners to any questions they have, if they put them into the Q&A box, and we will address those at the end of this webinar. But for now, yes.
William, I was wondering, just before we move on from inheritance tax, what we haven't touched on here, and I know we will come on to it further down the line, but I suppose the pensions falling within inheritance tax now. And I suppose the point I would want to draw out there is we would have a lot of clients who have done inheritance tax planning in the past, who have pension pots out, don't need to worry about that. Now we would recommend they go back and revisit their inheritance tax position. And it can be as basic as, people had assumed that they were below the £2 million in order to get the nil rate residence band that Sean had touched on previously, that you can lose when your estate goes over 2.35 million. So people would have undertaken planning, ignored their pension, but just overnight, your pension's now in, and you could have lost that £175,000 each. So it's definitely something, and I know there's been a lot of talk since the budget last year around the pension piece, but it's not to lose sight of that just, you may have an inheritance tax plan, but it may need revisited, because, some pension pots that now fall within the inheritance tax regime can be quite substantial.
Yeah,
it's a really good point, Kathy. It's coming in a year later as well, which adds to the confusion. Different dates, but yeah, the farming agricultural property changes next April, so 4 or 5 months away, and the pensions the year after, which is it's a really important point. I think we're going to cover that, William, anyway, aren't we?
Yeah, there's a pension item on the agenda later on, but for now, just for the sake of time, we're going to move on to income tax, and that's back to you, Sean, to do a short overview again.
Okay, yeah. So I think the biggest news in terms of the budget last week was the decision to freeze the allowances, so that we all have a tax-free allowance normally of £12,570. That's the first amount of income that's tax-free, and 40% income tax kicks in at just over £50,000, £52,770, and then 45% tax kicks in at £125,140. And there's a bit of an oddity in that if you've got earnings between 100 and 125,140, you pay an effective rate of 60% because you lose some of your personal allowance. I won't bore you with that tonight. Obviously, the big news was that the government have decided to freeze those allowances for a further 3 years. So they're not going to change until April 2031. So basically what that means is as incomes rise, more people are going to get caught in the 40% tax band, the 45% tax band as well. But it does, if you look at the numbers in the back of the budget documentation, it does raise a considerable amount of money for the government. And they're building on obviously what the previous government did as well by freezing those allowances. What we'll also see from 2026, so again 5 months away, is an increase in a 2% increase on the tax you pay on dividend income from shares. And that obviously impacts you if you run your own limited company, but it also impacts you if you own share-based investments normally. And basically what's happening is that the basic rate is going from 8.75 to 10.75, and the higher rate is going up by 2% as well to just over 35%. The additional rate that you pay if your total income is over 125 isn't changing. Okay, but that's one to look out for. If you're running your own company, it's looking at how you take your profits out of the business. And again, Des and Kathy will have a view on that as well, because you should always review that, and definitely on the back of these changes. And the other change that's coming in a year later, so from April 27, is that there's a 2% increase on tax on interest that you get from banks and building societies on your savings, but also rental income as well. The government are looking, part of their manifesto was not to increase taxes for working people, and they deem those sources of income as unearned. So that's why they feel they're still within their manifesto commitment by increasing those taxes. So that's a very brief overview of how income tax is going to work.
Yeah, thanks for that again, Sean. It's a good start to the discussion. I'm going to go straight back to you again, Des, for your perspective on where income taxes issues are.
No huge change, William, really. I think that's the key thing. It's just the creep of the fact that incomes will continue to rise and allowances have been frozen for a long time. Like 2031 is a long way away from where we are today. The couple of, I suppose, kickers in there are the 2% on the rents, which is the first sort of attempt at almost bringing an additional sort of a tax charge on passive income coming from rents and savings, and farmers do have properties and so on that are rented out, or lots of them do. So that's one thing that'll just come in and it'll be soaked up. The other, I suppose, bit in terms of the dividend piece, there was a drive for incorporation and the benefits of incorporation. If we go back and think about that, we were effectively, way back we were at 25, we were down to 19 and signalled going down to 17% corporation tax rate. And hopefully we had plans in Northern Ireland to get down to 12.5. That said, corporation tax rates have gone up to 25. And now whenever you think about, you've really only got 75 left of your income in a company, and then you go to take it out. And if you're at a higher rate and you end up paying 35, it's not particularly attractive. The corporate structure is not as attractive for many as it would have been previously. So it's a good enough way to accumulate money, but not particularly good if you have to get the money back out again.
Yeah. Thanks, Des. Kathy, do you want to add into that?
Just really, William, to highlight that probably a lot of the audience today aren't operating through a company, so the dividend rates shouldn't have a huge impact for them if they're in sole trade or a partnership. But as Des says, we know a lot of our clients also have rental properties, and it's more than likely that's where they'll see the pinch there.
Yeah. Peter, is there a legal aspect to this, or is this an accountant's topic?
I'll pass on the income tax thing.
Yeah.
Back when it's relevant again, I'm more worried as a consumer rather than as an advisor.
Yeah, no, fair enough. Well, does Sean or Des or Kathy, any last comments to move on to the next item's national minimum wage? But any last comments on income tax?
Yeah, I mean, I only thought, one of the ways to mitigate your income tax is through pension contributions. So for every £80 you pay into a pension, the government put 20 on top. And if you're paying 40%, you can then claim up to another £20 back off the revenue. And if you're caught in the 45% rate, you can claim up to another £25 back. So if you are making pension contributions, it's important to make sure they go on your tax return as well. If you haven't been claiming it, you can go back up to 4 years. And you'd be amazed how many customers don't put that on their tax return. And also, I think Des and Kathy, you talked about, people run their own limited companies. If you're a director of your own limited company, you're an employee technically, so the employer can make pension contributions for you. And if you're my age or older, I'm 57. I think I'm not that far away from being able to get my hands on my pension, so it's not a disaster. It's not like I'm 35. I've got to wait until in my mid-50s to take it out. You are much closer to being able to get your hands on it if you need it. But yeah, pensions, gifts to charity as well, and gift aid, that can help your income tax as well. But again, I won't bore you any more with that. I'll let you move on with it, William.
Yeah, no, but thanks for that, Sean. Next item then is national minimum wage, and I think Kathy, I'll bring you in first on that one, if that's okay, or Kathy or Des, whichever you.
I think the slide's just to highlight that there will be an increase again from April 2026 throughout the UK. And I do say again, you can see the percentage increases there, and they're quite substantial, and they will have an impact on businesses. And it says there the Agricultural Wages Board will meet in January 2026 to set the Northern Ireland pay bands. But I suppose it's just to let everybody know that it's coming, and it will have an impact.
Yeah. And to me, farmers as a whole are looking at the inheritance piece, but there's a lot of creep in other taxes here that they're all minuses of our income for the year, isn't that right?
They definitely are, William, and I suppose it all kicks through, if you know what I mean. Mm-hmm. And I suppose the pricing and the value for our produce needs to reflect that cost increase, because if it doesn't, we're getting our margins squeezed, really. I suppose the economy has seen inflation, and particularly food inflation, but it's only a natural product of increasing wages and increasing the cost base, because it has to be carried through the chain.
Yeah. No, thanks for that. Next thing, we're round to pensions, and Sean, you want to do a quick overview of that before we open it up to the floor?
Yeah, of course. Could you move this on, Dan? Thank you. Yeah. So, there's a couple of changes. I think probably move on to the next one, Dan. It'll help set the scene a little bit more. Okay, there we are. Brilliant. Okay, so obviously we've got the changes to agricultural and business property, which are massive. A year later, I think Kathy's already touched on it, is that pensions from April 27, anything left in your pension funds on death will be included in your estate for inheritance tax. Again, I mentioned earlier on about anything left between spouses and civil partners is exempt without limit. So if I die and leave my pension fund to my wife, she won't pay any inheritance tax on it. If I were leaving it to my children, then that would get hit. So, and again, it increases people's estate. And Kathy mentioned, I mentioned this 2 million for getting this extra tax-free allowance on your home, and pensions, as Kathy rightly said, will pull many people way over 2 million with their pension funds added in. They'll end up losing that. There are ways and means around it as well, which I won't bore you with now. But again, it's about taking advice. So if you could move on, Dan, to the next one, please. Okay, the other thing to look out for as well is that, as well as inheritance tax, there can be potentially income tax on the pot. So if you die before age 75, your beneficiaries can take the money out of the pension and pay no income tax. But if you die after 75, they have to pay income tax as well on what they take out. So I'll give you an example. I die at aged 76. I leave £100,000 in my pension pot. Let's say it's subject to inheritance tax. That's 40%. So there's £60,000 left. If my children decide to take that in one go, they'll pay income tax when it's added to their income. So as an example, let's assume they're both 40% taxpayers. They get £60,000. There's another £24,000 in income tax to pay. So that leaves my original 100 down to 36,000. So that's a big problem. We were hoping that was going to change in the budget, but it hasn't. So that's a big issue, but there's things you can do. So if you could move on to the next slide, please, Daniel. Okay, so what should you do? Well, the important thing to say is until April 2027, the money in your pension is free of inheritance tax in the vast majority of cases. So it's providing you with that shelter at the moment. So be very, very conscious of people not taking all their money out of their pension and trying to do something with it. You've still got that protection till April 27. But as we get closer to that, it definitely makes sense to take your tax-free cash once you reach 75, because at that point, it will only be subject to inheritance tax if you take it and put it in the bank or whatever, but it won't be subject to income tax. That's really important. And you might choose to invest that in other products that can help mitigate inheritance tax, or you can give it away and hope you live 7 years. But what we think we'll see more people doing is taking more income out of their pension, because there's an exemption from inheritance tax called gifts out of normal expenditure. And the way this works is it basically allows you to give away your excess income. And as long as you're making the gifts out of income and not capital, they're regular, so a pattern to them, normally every quarter or every year or whatever, and it doesn't impact on your normal standard of living. You can give away as much excess income as you like. So we had a customer fairly recently who was pretty wealthy, was getting a lot of passive rental income. He had an after-tax income of £200,000, but he was only spending 50. So he could give away that excess income, any amount up to it. So you can, we'll see people increasing the amount of income they take from their pensions and giving away the excess if they can afford to do it. Or some of them will use it to fund a life insurance policy, a whole of life that pays out to help pay the inheritance tax. So again, there's ways and means around it. Daniel, if you could move on to the next one, please. Okay, so another thing, we were a bit worried as we approach every budget, the amount of tax-free cash you can take out of your pension would be capped at a lower level. Currently, it's 25% of your fund, up to a maximum of it's a lovely round figure, 268,275. Okay, unless you've got some sort of protection where you've registered. If you've got a big pension fund, you might have registered for protection. So the good news is that hasn't changed. There were fears the government would bring that cap down to 100 or 150,000. And importantly, there's no change to tax relief as well. So that's the tax incentive you get to pay money into your pensions. And Daniel, if you just move on to the next slide. I think I've probably already touched on this, but if you can move that on. Thank you. Yeah. So as I said, every £80 you pay into a pension, you get, the government add £20 on top. If you're paying, even if you're a non-taxpayer, that is as well. Higher rate taxpayers can claim an extra £20 back off the revenue, so they get a pot of 100 at a cost of £60. And the other thing to do as well, if you want to gift assets to or give cash to the younger generation, you don't necessarily have to give them outright gifts. You can, if you want to, invest in pensions for them, or you can do investments for them in trust. There's lots of ways of getting rid of that excess income out of your estate for inheritance tax. Okay, I think that might be the last slide, Daniel. Or is there? No, there is salary sacrifice next. Let's just move on to the next one. So a change that was in the budget, and this isn't coming until 2029, so we've got a good run up at this one. Basically, what they're doing is they're putting a cap on what they call salary sacrifice. Now, salary sacrifice works for, if you're an employee, you can give up part of your income in exchange for your employer paying the same amount into your pension fund. Now, the advantage of that, if you're an employer, is that it saves you 15% employer's national insurance on what you put in your employee's pension. So if you wanted to give your employee £1,000, if you pay it to them as a bonus, it costs you £1,150 because you have to pay 15% national insurance on it in most cases. If you put it into their pension, it just costs you £1,000. And for the employee, they currently don't pay any national insurance or tax on anything you as the employer put into their pension. Now, unfortunately, what was announced last week was the cap on this. And Daniel, if you could just move on to the next slide. So what's going to happen from April 2029 is there's going to be a cap on the amount of pay that can be sacrificed for salary sacrifice to get the same benefits as now, and that cap's going to be at £2,000. So anything over £2,000 is sacrificed. Both the employer and the employee will have to pay national insurance. And Dan, if you just move on to the next slide, so we've got a quick example there. So yeah, here's a very quick example. Employee earning £50,000 a year, they sacrifice 10% of their pay, £5,000 in return for the employer putting it into their pension. Because it's over the £2,000 cap, the employee will have to pay 8% on the bit over 2,000. That's £3,000 taxed at 8%. National insurance is £240, but the employer will have to pay 15% on it, and that's £450. So I say it is a change coming in. We've got a good run up at it. Just moving on to the next slide, Dan, the final one, I think, is the option. So it's only salary sacrifice where the employee makes a conscious decision to give up part of their pay for an employer pension contribution that's affected by this change. Any money paid in by the employer, just part of the salary package, is not impacted. So I think what we'll see more of is employers choosing to limit future pay increases and perhaps pay more into the pension because the employer saves the national insurance on it. And I think there'll be much more negotiation going on between employers and employees on how they're rewarded. And I think and what I'd say is just make the most of it while it's still here as well. Salary sacrifice is valuable.
Thanks, Sean, for that overview. Kathy, do you want to come in and sort of comment on the pension aspect?
I think in summary, pensions have been hit, and they've been hit hard in the last two budgets, obviously with the inheritance tax piece, but as Sean pulled out there are things you can do. There's a big difference pre and post age 75, but one of the points that Sean touched on there, which we often see as a really underutilised exemption, is the gifts out of normal expenditure. And the point to draw out there is if you can establish that pattern and meet the relevant conditions, there's no 7-year clock on those gifts. They're out of your estate immediately. So that's extremely valuable. You can start to draw down your pension, gift the money away, and if it meets the conditions it needs to, it's gone, and there'll be no inheritance tax. One point to note there is you should be recording all of these transactions. If you were to die within 7 years, there's certain forms to be filled in by the revenue. So it's just making sure you record the gifts appropriately. But sometimes when we talk to clients about this exemption, they're doing it without knowing it. Sometimes making regular gifts around Christmas time to grandkids or children. So they're already within the exemption without knowing it, but it's really important to keep the records. So yes, pensions are in, but there are steps you can take, and it's definitely worthwhile looking at that.
Yeah, I completely agree with that, Kathy. You mentioned the record keeping. That is so important because when the family are sorting out someone's estate, this is claimed. This gift out of normal expenditure is claimed by the family. It's not given automatically. And if everyone wants to Google this, it's called IHT 401. I think it is back page of that. I might be wrong. Is it 403? Can't remember. Which one of those? Back page. You can record your income, record your expenditure, and record your gifts. And it's so helpful to the family, I can tell you, when it comes to sorting out someone's estate. Not often you refer people to the revenue, but that one is actually really useful. You're right, Sean. It is. I can't remember which number it is, but yeah.
Yeah. Des, do you want to comment there?
Get off mic here. Nothing major, William. I suppose the good thing, or the only good thing, that was that the the fear was that we would have either reduced reliefs in terms of the pension contributions, either taking away the top rate or reduced ability to withdraw your tax-free 25% lump sum. So they haven't come into play, but I would still not want to be overly confident that whenever they have to revisit things in the future, that some of those things will be back into play. So a lot of what Sean has talked about, I think, will be very much in play.
Yeah, thanks, Des. Peter, is there a legal aspect to this, or?
Not particularly, only to endorse what's been said. A lot of the time when we're claiming this relief, when we're filling in inheritance tax forms, it's people didn't realise they were doing it. They were supporting somebody, a grandchild or somebody at university, regular payments like that were, you were able to pick up on. But if your income, if you're in the very fortunate situation, I suppose, that you don't need to spend all your income, it's definitely one that people don't make enough use of deliberately, and the ones that we've seen for where it's happened accidentally, it's been very useful.
Yeah, and record keeping is important.
Ironically enough, that's the thing I was going to say across the board for all the changes we've talked about tonight. It's going to be record keeping.
Yeah.
I don't think I have seen a written Conacre agreement more than a handful of times in a near 30-year career.
Mm-hmm.
Farming partnership agreements are like hen's teeth unless you're in the Young Farmers Scheme and somebody was calling for one. All of this stuff is going to have to be documented in the future. And the revenue just eats paper. And we're going to need to have that paperwork to be able to claim these reliefs. Yeah.
Hey, are we happy enough to move on, or is there any other comments on pensions? Silence. So, well, the next item is ISAs, individual savings accounts. Kathy, do you want to lead off on that one?
So ISAs were specifically mentioned in the budget, and we can see there that the limit will stay at £20,000. But it's important to note that the cash element of that can only be £12,000 within that overall £20,000 cap. For over 65s, you can continue to put in the 20,000 in cash. So the other 8 would need to be in a stocks and share ISA. So I think the headline, people thought it was actually being reduced, but it's not. It's still, the cap's still 20. You just need to look at how it's invested, I suppose. ISAs still remain extremely tax efficient for income tax. But I suppose one point to highlight is they're not so good for inheritance tax, which I keep focusing on. An ISA will fall within your estate for inheritance tax purposes, but in lifetime, they are extremely tax efficient.
Yeah. Hey, Sean, do you want to come in there?
I completely echo what Kathy's saying. I mean, I think as we're seeing, obviously, the tax rates that you pay on your interest in building societies and your dividend tax rate going up, an ISA becomes more valuable, really, because it's just all it is like a shield you wrap around either cash in the bank or stocks and shares, and it keeps it tax free. So, make the most of them, because they do provide those tax advantages. I think the other thing I'd say as well, when this was first announced, we thought, well, won't people just put 20,000 in the stocks and shares? Those who want cash ISAs, won't they put 20,000 in the stocks and shares and just transfer it back out to cash, to a cash ISA? Because you can move money between stocks and shares and cash ISAs. But unfortunately, in the rules, there's now a provision that says they're going to stop that, basically, to stop people doing that. And also, with an ISA and Millennium Mutual one we've got, we offer, the lights have just gone off in Stratford, I'm afraid. We offer like a cash-like fund that invests in things that are very much like cash, that offered like very low risk. But it looks like the government are going to crack down on those as well to stop ISA providers allowing those sort of funds to be held in ISAs. But yeah, however you want to invest, whether it's in cash or stocks and shares, if you're investing for the longer term, just make sure you use your ISA allowance.
Yeah. Thanks, Sean. Does any comments around ISAs?
No, not a big thing, William. We've had clients who have used ISAs incredibly effectively over the years, absolutely amazingly effectively, and they've been sort of religious in terms of making their contributions and have accumulated significant worth, and it all has grown tax free. What I would say is, and it's a wee bit going off on a tangent, but sometimes when you've got that lump of funds at a particular point in time, they may want to consider looking at a discounted gift trust, which is an effective way of actually putting the money into a different fund, but from an IHT angle, then that money will fall out of your estate. Some of it will fall out immediately based on your age and so on in terms of what discount you get, and the balance of it will fall out over 7 years. And you can still get a return of capital out of that of maybe 4 or 5%. So it can be an effective way to allow those that have accumulated the wealth to put it into a vehicle that'll give them a source of income or a source of capital that'll serve a purpose, but it equally then is a way to actually put it away and beyond the scope of inheritance tax.
Yeah. Thanks, Des. Hey, Peter, is there a legal?
No, ISA's allowances again are probably very much accountancy rather than legal, although I mean the trust aspect is one that probably could be looked at, but trusts for cash and stuff like that are more appropriate maybe than they are for land.
Yeah.
William, if I may, I've just got one point that's in my mind, is that it's really important that if someone dies and they've got money held in ISAs, their spouse or civil partner can inherit the value of their spouse's ISA. So as an example, I die and leave £100,000 in ISAs. My wife, let's say I leave what's in the ISAs to the kids, my wife can take advantage of my ISA, my £100,000 ISA wrapper, if you like. It's called an additional permitted subscription, but it's one to look out for because a lot of people aren't aware of it. But you can inherit whatever your spouse has built up in ISAs. You can inherit that ISA wrapper, whatever it's worth, to use it yourself. But
and that would there'll be no tax liability in that situation.
No, absolutely none. So again, in that example, let's say my wife's got £100,000 in ISAs. I've got the same. I die. I leave my investments in my ISA to my children. My wife can still get the wrapper worth £100,000, whatever mine was worth when I died, and she can, if she's got another 100,000 lying around somewhere, she could put that into my extra ISA wrapper. It's called an additional permitted subscription. So it's one to look out for.
Yep. Thanks for that. We'll keep pushing on because the time's getting on. Next item is sugar tax. Kathy, do you want to comment on what the Chancellor has done to, I suppose, the ones that farmers are aware of, the tax on the milkshakes?
That pretty much the sugar tax will now be extended for additional products. So sugary milk-based drinks and milk substitute drinks will be removed from that exemption. So they're now brought within the scope of the levy. The threshold will be reduced, as stated there, and it'll be effective from the 1st of January 2028. It is expected that most of these products will be reformulated to avoid this levy. So I suppose they're bringing it in with that knowledge, really, that will happen, but it's definitely worth being aware of.
Yeah. Thanks, Kathy. Anybody else want to comment on that, or do we move swiftly on? We'll take the silence as no. The next one, this is another one of these ones that are sort of creeping up and sinister in my view. It's fuel duty and the adjustments that are going to be made on that. I'm going to go back to you, Kathy. I'm sorry for targeting you with these, but you want to talk us through the fuel duty, please?
Well, again, just from September 2026, the main rate will increase, returning back up to 57.95p. It will happen gradually, but that's where it's to end up. The reduced rate for red diesel will go back to 11.14p per litre, and from April 2027 the fuel duties will increase with retail price index. So just all quite factual.
Yeah. Des, do you want to comment on this one?
Not really, William. It's just one of those creeping things, you know. The red diesel will come back in. It's another penny. There's costs and other things there, and there's now got a charge on electric vehicles as well. So there's all sorts of just moving it on bit by bit.
And you combine that with the pickup trucks situation last budget and all the other ones. It actually accumulates to be noticeable, doesn't it?
Lots of wee squeezes in different places, and they all add up. There's no doubt about that.
Yeah. I think we'll move on then. The next one is capital allowances, and I'll maybe go straight back to you on that, Des.
Sure, and there's a few changes in this one. And it's probably important that farmers are aware. We have a fairly generous capital allowance regime at the minute, or had a fairly generous capital allowance regime, in as far as we probably have a first year allowance of up to £1 million for those that are unincorporated, and for those businesses that are incorporated, then we've got basically what's it called, Kathy? It's called your full expensing provision. Basically, yeah, you're effectively allowed to write off in year without limit almost at this point in terms of any capital expenditure for plant and machinery. Now, what they have introduced is a 40% first year allowance for main rate expenditure and plant machinery, and that's really going to be driving it at the unincorporated businesses. So that, if you could think of the two regimes, the companies are getting full expensing, unlimited partnerships and individual are up to $1 million, and then above $1 million now you've got 40%. So it's beneficial that we've got the 40% rather than what would have been at 18% effectively as it was. That said, then on the other side of it, the mainstream corporation or capital allowances rates are being reduced. I don't think it's on that slide. Yes, it is, from 18 to 14%. So that's where that's going to be a bit of a take in that. So normally in your normal writing down allowances, when you go past your first year allowance, the balance of it was written off at 18%. It now scales back to 14%. But at the minute, with $1 million of a first year allowance, you've got a fair chunk there. That said, for those, if you think about it, that are doing bigger capital projects, whether that's in the pig units or whether it's in poultry units, you can very easily exceed the £1 million in a particular year, and you can fall foul of that. So it'll be welcome to see that 40% is there, at least to top up beyond the $1 million.
Yeah, and the reality is $1 million isn't as big a number as it used to be, just the way inflation and all these big projects can add up now.
Absolutely.
Yeah. Hey, Kathy, do you want to add anything there?
Just that it's encouraging that they still want people to spend, and they're given the relevant reliefs attached to that. So it's just encouraging to see another new first year allowance. But yes, as Des says, the drop in the main writing down allowance will impact people too.
The one thing I would say, William, and farming is a particularly complex one in relation to what is plant and machinery. Plant machinery isn't red or green necessarily and have four wheels. It is all of your. It can be all of your infrastructure. So silos, tanks, farm buildings. But when you get into that project costs, it's very important that you can appropriately differentiate what is plant and qualifying for 100% relief, and what is buildings, residually buildings, and will only get a 3% relief. So I think I would encourage all farmers to make sure that they engage with their advisors and there is a proper understanding of the projects that are being undertaken, so that the appropriate reliefs can be claimed. Because that's where, in our area of work and in the agri field, a project it will involve a lot of things, from digging out the tank and to building it and putting slats and putting cubicles in and mattresses and gates and all sorts of things. So you have to understand the specifics of what you're dealing with to make sure you get the appropriate allowances. It's not all the big shiny tractors and mowers and all those things.
Yeah. No, point well made. Yeah. Peter, is there a legal aspect to this one?
No. No, I mean, no. Capital allowance is very much accountancy side of things, I think. So yeah. I'd definitely leave that to them.
Not so bad. Sean, do you want to add
nothing to add to that?
Yeah. Right. So that's capital allowances. So we're coming to the end of our agenda as such. But as I said at the start, we have Alexander Kinnear on, and Alexander's our political person within the union. He keeps an eye on what's playing out in Stormont, Westminster, and indeed Brussels. and he has been a very close follower of the whole political background to this budget for this past year, really from the 24 budget to now. And actually, the budget, this year's budget, was being debated in the House of Commons tonight. Alexander, is that right?
Yes, that's correct, William. Yep, there were a number of votes tonight. So I think just to start from the start, I would say politically this isn't over yet, and I think that's important to remember. And I appreciate, obviously, people will want to plan, but we are watching this like a hawk, and this will likely continue on into Christmas and into the start of January. As William alluded to at the start, we're now over to the deliberations around the finance bill, which is the legislation basically needed to pass the budget. And I suppose the strategy we have embarked on now for over 12 months has been to work with the rural Labour MPs, many of them who are elected, well over 100 of them, all with low majorities and who want to stand by and do right by their constituents, or so they tell us. I remember at the Icon Centre last year, of course, we said to people that we would do everything within our power. And of course, that's what we meant. And we have stood by that. Many have claimed, about more protesting and doing different things like that. But that has been extremely difficult. And obviously, Northern Ireland, where it is geographically, we don't have any Labour MPs. We have embarked on a strategy of working with the other farming unions across the United Kingdom and trying to not only build up our own support, but try and aid them in their lobbying with Labour. So, of course, it has been mentioned about the spousal relief, which is a success of political lobbying, and I think it's an important milestone, albeit it was very small, but to recognise that from last week. Tonight there have been a number of votes taking place on budget resolutions so that basically means various parts of the budget, whether it was capital gains tax, income tax, and of course inheritance tax. So there was one specific vote tonight, which I assume we will hear much more about tomorrow in the press, and that was resolution 50, which was inheritance tax. So there was lots of agriculture mentions tonight as well in various speeches, which was good to hear. And the Labour Rural Research Group, which is a group of MPs that obviously come from rural constituencies, they have clearly broken ranks to to say to the Treasury team that they are not happy about where things are going to, not only as a party but economically the policies the parties have embarked on. So we're still sort of crunching through the numbers. There's probably about 40 abstentions of Labour politicians tonight, which is good. That's what we were expecting. I just really can't confirm that number yet because we're still going through various lists. But that will be largely positive from where we're at tonight. And I know, obviously, farmers and constituents would like to see Labour MPs coming out completely hard and rejecting the proposal. But again, as I alluded to before when I started talking, this process has a few more weeks to go. So there were 87, I suppose, Labour MPs in total that there was no vote recorded to tonight. A number of those will obviously be travelling. A number of those are ministers. But roughly about 40 of them have clearly abstained and not done what the government have wanted them to do. So I suppose as a result of tonight, this again moves into amendment territory, and the current budget finance bill moves to committee stage, whereby the government may decide in a few weeks that they will amend it, given the strength of feeling that's on the Labour benches, or indeed a backbench Labour MP will take some version of an amendment forward based on really what the 4 UK unions and others have put forward. So I suppose our positions, the first one is, as William has said at the very start, we want to see full reversal of this policy. However, we have to be realistic about the climate we're in, and I think since the Chancellor really made very little mention of it in the budget, full reversal is clearly not an option that is most likely at this stage. Our organisation passed other measures which we're pushing for quite hard. One around a morality clause, whereby the elderly, terminally ill, and those that suffer with farm fatalities, which obviously happen very suddenly, would be exempt. We have also mentioned other models whereby if you inherit a farm and farm it for 7 years, you would be exempt from any inheritance tax measures as well. Another measure which has come about, and the NFU in England have pushed this quite heavily, the other UK unions have backed it, as well as our own executive as of last week, is for the government to remove the anti-forestalling clause in the finance bill. And that would mainly mean that anybody who transfers land between now and the 1st of April 2026 and passes away subsequently after that would be exempt from inheritance tax measures as well, obviously because the gifting rules just wouldn't be allowing them. So there are a number of steps here to go through, and I think whilst this is difficult to hear and it's a tough going subject, politically we're going to have to be quite flexible over the next couple of weeks and try our best. But again, I really do want to stress this process is far from finished, and we have a number of steps to go to. And again, I think tonight is another positive step, that there are a rump of Labour MPs clearly not happy about the direction of travel. And again, we're going to have to try and maximise their unhappiness with the Chancellor and the Prime Minister.
Thank you, Alexander. You and me have been hearing for a few weeks, maybe even a couple of months now, about that there is up to 40 Labour MPs willing to go against it. But it's reassuring to get this confirmation tonight, isn't it?
Yes, without a doubt. This is the first time, if you like, there will be a public record of their voting intentions, even though they've only abstained. And I suppose as well, from the day of the budget, with the various debates that have been taking place in the Commons, there have been quite a number of Labour people who have went public with their concerns, and they're not completely dishing the government. They're obviously very happy about various policies that they've went ahead with, but they're asking the government to do better and really to listen. So I think all hope is not lost, and really from our plan from quite a few months ago, the finance bill was clearly a part of that, and again, that has a few weeks to run yet before we really know our fate.
Yeah. Hey, do any of the panelists want a comment on anything Alexander has said, or a question, Alexander? There you go. No question. You've got enough late tonight, Alexander. At this stage, I would remind everyone, if they have a question that they want to ask, put it into the Q&A box, and Daniel is clumping similar questions together, and we're going to start. We're going to start working through those just now. Sean, if I can go to you, back on the inheritance tax piece at the start, you used the example of Peter. And this question refers to that example, and it's asking, is Peter's 1 million and also his wife's 1 million relief, is that only available if the farmland is equally in the wife's name, or does that work if he is the sole owner?
That's a really good question, because if you look at obviously you've got a £325,000 allowance and an extra 175 against the house. Now, if the person's late spouse didn't own a share of a house, they still inherit the 175 allowance. So there's no necessity for them to have owned a house in order for that to be transferred across. Now, I've asked exactly the same question to the head of tax at the NFU about this, and that question's gone in to the Treasury just to seek that confirmation. But if it aligns, as we suspect it will, if it aligns with the other allowances, the 325 and the 175 on the home, it should follow that the spouse won't necessarily have had to have owned farmland, but we await confirmation of that.
Yeah. Thanks, Sean. Peter, do you want to comment?
Yeah, sorry. I wouldn't say I've been ignoring the accountants talking about the taxes and income tax, but I know that there were 24 questions, so I asked Daniel's permission. I've been trying to answer some of them by typing, which is why I've been typing away there. And that one I have said exactly what Sean has said. Certainly the perception would be that on the first death, you can pass on an unused allowance without actually having owned agricultural property. But when you actually go to play that card, you have to own agricultural property. So ultimately what we're probably looking at here is either varying wills that don't do this, or having wills that say you leave at least what allowance they're going to use to somebody if they don't have agricultural property, And if the person without agricultural property passes away first, then that rolls over to the person who does own it. So you don't have to, but if you're the person who is sort of with the last musical chair, you're the person standing at the end, you have to own the property to actually be able to use the allowance.
Yeah.
Yeah.
Thanks,
If there's any
Peter.
version of that question I think I've actually typed an answer to that should be available, because I think we're going to struggle to get through all of these.
Yeah.
I mean, just one more point I will make on that, William. On the sort of standard 325,000 and the 175 on the house, let's say, for example, my spouse had predeceased me and I marry again. Potentially, between myself and my new wife, we could have 3 bites of the cherry. So I would use, in my will, I would say, right, my 325 and my late wife's 325 would go into a trust on my death, and the 175 leave it to the kids. But my new wife, she could do her own thing, if that makes sense. I don't want to make this too confusing, but it is potentially possible in those scenarios. We call it 3 bites of the cherry. What isn't clear is whether that will work for this £1 million allowance for those that have perhaps been predeceased who have then remarried. If that makes sense. Peter, I don't know if you've got any thoughts on that.
I don't think they have any detail on that as yet, but what I would say is, ironically enough, what we've just discussed is the one benefit that comes from the change last week. The problem before last week was everybody was going to have to own agricultural property. Now that doesn't always have to be the case. That's why this is actually, I mean, it's a spoonful of sugar to help the medicine go down at the end of the day, but at least we've got a spoonful of sugar.
Yeah.
Hey, Daz, have you a comment on that, on this one?
Agree what Peter and Sean said. It is beneficial. It avoids sort of where we were at this point was starting to draft wills and leaving the maximum available as we used to do in the old days under the effective 100% APR limit. So it'll remove the requirement to do that, and it should just make life a wee bit simpler.
Yeah. Hey, Kathy, where are you on this one?
Just to echo what Sean and Peter have said, there's very little information has actually been released on this. One of the revenue guidance notes where they provide examples, they have stated, so it does not matter if the first spouse to die owned the farm or other agricultural assets, but we need to see the detail to see exactly how this is going to play out.
Yeah, thanks for that. Hey, next question. I'll ask you to lead on this one, Peter. How important or sensible is it to get a valuation before gifting?
Yeah, that's one of the ones I was typing the answer to. And ironically enough, the reason you've asked the solicitor that I know, William, is because I'm actually a committee member of the Northern Ireland Rural Valuers Association for reasons even I don't understand. In short, the answer that I typed to that, which applies to everybody, is we can't, accountants in particular and lawyers cannot give advice about how to deal with your problem if we don't know the extent of your problem. And I remember the briefing that Jeremy Moody, who you'll know, William, gave immediately after the budget was that up until now, agricultural property relief claim valuations have been about pictures. As soon as you could show that it was a farm through pictures, there was 100% relief and the revenue left you alone. Now, valuers are going to be literally counting the number of bales in the yard and going to have to be valuing your stock. James McCluggage would have heard Tim Martin talk about this at the STEP conference a couple of weeks ago. It doesn't need to be the 20-page valuation that we would be getting for inheritance tax, but you definitely do need to have a realistic valuation. I've described it as if you were stopping farming tonight at midnight, going down the lane and padlocking it and throwing me or somebody else the key, what would you be looking for to give up that farm business? And that is the figure that you need. It probably involves land, your machinery, take off your liabilities, what you owe the bank and what you owe on your machinery. But valuers are talking about literally having to count the round bales in the yard at the date of death.
And that sort of that process of getting that valuation and all done, like that's going to be a horrendous situation from a time point of view. You know, when you combine it with probate and all of the process that has to go through.
Tim Martin pointed out that the number of people that can actually value livestock in Northern Ireland is relatively small. I mean, he said it would have to really be an auctioneer.
Yeah.
That homework is then marked on behalf of the Inland Revenue by the district valuer and the Land and Property Services. And I know that they are short-staffed. I'm not going to mention I am going to mention the A6, but that's all I'm going to say about it. they are absolutely hamstrung with the amount of work that they already have. So
Yeah.
we don't know what's going to happen, whether they'll have to go private and bring people in to mark Northern Ireland Valuers' homework. But speaking, like I say, as a concerned member who's never done a valuation in his life of the Northern Ireland Rural Valuers Association, I know that that they think this is going to be a big issue. The accountants will confirm whenever you have an inheritance tax issue, the HMRC recommends that you actually get 2 valuations. Now, if we only have a number, if you need 2 auctioneers to value your livestock, that's going to be a nightmare. The practical implications of this for us as advisors are actually fairly significant as well.
Yeah. Thanks for that, Peter. Des, do you want to comment on this one?
William, I don't know what the question where somebody was asking about whether you needed a valuation for gifting.
Yes.
I think maybe that was a question, and technically I don't think you do. You need to put your best estimate in. So when you're claiming holdover relief for capital gains tax purposes, you do have to obviously get the relevant forms signed. You have 5 years, 4 years, 5 years from the date of gift to make sure it's signed. But you also should get it done at the time to make sure it is signed by the donor and the donee. But to my mind, you use a best estimate. So the formality of getting a valuation at point of gift, I don't think it's required. It is required, obviously, for IHT.
Yeah.
Hope I'm not contradicting anything that anybody else is saying there.
No, that's true. That was actually a gift in the question. That's fair enough, Des.
Yeah. Kathy, have you anything to add there?
Well, just as the gift, obviously, if you make a gift and survive 7 years, the value should never be called into question, typically. But if something were to happen within the 7 years, then it's a failed gift. It does be brought back into your estate, and that's where you can get into negotiations, let's say, with the revenue in terms of what the value of that gift actually was. So Des is right, technically, you don't need to go and get one, but you're probably on a better foot if you've spent a bit of time getting a valuation, so that if the revenue query it, you're easily able to produce your evidence to support the valuation. But, as Des says, for certain tax reliefs that you would be claiming, you can use estimates. It would just put you, I suppose, slightly in a better position if the revenue do come back to question of value.
Yeah, thanks, Kathy. Sean, have you anything to add to this
Yeah, I
one?
just echo what Kathy's saying there, is that if you've got a formal valuation, it certainly does, it's easier to challenge, in the event of a revenue challenge. I will go back to that point I mentioned at outset, just as we see a little bit over here, of it's the market value is what the revenue are interested in. And, any sort of development potential on land and buildings, it's important to get that recognised, I think, up front.
Yeah. Thanks, Sean. Next question is it right to set up gift trusts for combined assets? Or so basically, what are your views on gift trusts for combined assets? Des, we'll lead with you on this one.
I'm not sure what the context of the gift trust piece is. You certainly, I know I had talked about discounted gift trust, which is effectively a wrapper that you can put around an investment that produces a beneficial point of view from inheritance tax. So that is, each person has their own effectively discount rate and discount amount, and each person has their own separate 7-year clock. So in that context, it is the joint aspect of it won't really come into play, because each person will stand on their own feet as far as that goes. If we went into the wider trust thing, then the trust provisions, and they are there up to April 26, where we're not subject to the 1 million limit in terms of what value can go into the trust of agricultural assets. So in this window of time up to April, then we've got flexibility in that we can put more value than the million and still achieve our 100% APR on the gift. That said, I think, and I don't know what the rest of the panelists' views are, but trusts are complex enough pieces of structure, and not really probably for a lot of basic farmers, in my view, because it adds a layer of complexity. That said, it does offer protection, and it does sometimes buy time for things to be done, and done at a later point in time, where you may well be subject to exit charges from the trust. But that time might allow for proper planning. So it's not something to be taken off the table. This is probably more Kathy's area of expertise than it is mine, and probably Peter's, but it's certainly in a planning context, it's relevant to have under consideration.
Yeah, thanks, Des. We'll go to Peter and then Kathy. But Peter, you put the legal perspective to this, please.
Yeah, I mean, certainly there will be a lot of land in trust, particularly on the mainland in England. But there was a lot of discussion about this at the STEP conference a couple of weeks ago, and I know there's some attendees from that online here. But ultimately, one of the biggest issues we see with trusts is trust land no longer belongs to you. If you want to borrow it and you're against it and you're in a working farm, the trustees have to go and borrow that money and then lend it to the actual active farmer. So if you can afford to put your land away and you're fairly certain you're not going to actually need to use it, and a lot of farms I know do use it. There's very few farmers I act for that don't have a charge against a part of the farm somewhere. But the next time that you're doing a large amount of capital works, the next time you're replacing your parlour or you're building a new hen house and you think you don't need to borrow against the land, then maybe a trust is appropriate. But for a lot of medium, average, for want of a better phrase, working farms, trusts have that downside that the land's not yours to borrow against. And whilst there's a lot of talk for those who don't have to borrow against their land that this is what they should be doing, it's less practical for the more sort of middle of the road farm.
Thanks, Peter. Hey, Kathy.
As Des said, there definitely is an opportunity here to use a trust vehicle if you want to in advance of April 26. There's an uncapped, APR and BPR is uncapped until that point. You do have to survive 7 years in order to fully benefit from that. Trusts, we generally see them used when people are concerned about protection of family assets, so against divorce or legal proceedings, albeit it could be limited, the amount. Peter might have a view on divorce scenario protection, but they definitely do have a place, and particularly if the family doesn't have a successor, where the mum and dad would be the trustees and they can still control those assets as such. But I completely agree with Peter's commercial aspects. It won't work for everybody. And when the asset goes to trust, it's in trust and it's not yours anymore.
Yeah, sorry to come back where Kathy had sort of referred that to me there. Yeah, I mean that is the issue. We would see this in wills where there is a successor with a matrimonial issue, a successor with a financial issue, or although you wouldn't have this for a successor, there's a disabled person who can't manage their own affairs, and that's where we would have trusts nowadays. The other thing we should say about them is if you leave an asset in a trust for 10 years, you pay 6% of the value of that asset in an anniversary charge every decade. You would probably get 50% relief on that for an agricultural asset, but if you want to pay 3% of the farm every 10 years, that's the problem if you leave it in there. So Des is very correct to say that it's a short-term, immediate solution. If you leave it in there for years and years and years, it actually won't take it very long before it actually mounts up that you're paying the same as inheritance tax on
it. Thanks, Peter. Sean, do you want anything to add on trusts?
Yeah, I mean, there's a whole host of different types of trusts that you can have, and the assets. We talked about putting farmland in there. I think you could put cash in there. Des, you talked about discounted gift trusts, which are for people putting cash away and getting an immediate discount on their inheritance tax. After 7 years, the money's completely outside your estate, but you still have carved out this right to a payment every year for the rest of your life. So when people talk about trusts, they can be a double-edged sword. I mean, Kathy mentioned it about, obviously, once you put something in a trust, it's no longer yours to do what you want with. And there obviously can be the sort of flip side of that is it can offer asset protection as well. Particularly in the case of family breakdown, there's trusts you can do to make provision for disabled or vulnerable people as well. So trust is a big subject, and there's lots of different types, and there's lots of advantages and disadvantages depending on what the situation is. So there isn't one right answer to that question, I'm afraid, but it is about getting the right advice and seeing how trust might be able to work for you.
Yeah, a case-by-case discussion.
Absolutely.
Yeah. Hey, thanks for that, everyone. Hey, next question. How does agricultural property relief on a farmhouse tie in with the £175,000 relief? Hey, Who wants to? Sean, you're on the screen, so have you a view of that?
Well, I think it was going to be me or Peter you're looking at then, but yeah, I mean, so farmhouses can qualify for agricultural property relief, but there's quite a few hurdles that need to be jumped. So the first one's got to be occupied for agricultural purposes. So the people living there have got to be living there to do the sort of day-to-day farming. We see a lot of problems over here. I know it's a different system. We've got farm business tenancies over here. So we see a problem where a farmer retires and lets all his or her land out on a farm business tenancy. They're not actually doing the farming anymore. And if they're not doing the day-to-day farming, they can't be living in the house for agricultural purposes. So that's the first hurdle you've got to jump. The second hurdle you've got to jump is it's got to be what they call a character appropriate, which has got to be proportionate in size and nature to the requirements of the farming activities that are going on. We see cases over here of someone perhaps living in a very grand farmhouse. I know it's different in different parts of the country, but it was once a farmhouse for a far bigger farm. And over the years, blocks of land have been sold off. And it's now a very grand house, and the revenue say that's too big to be a farmhouse. It's also important to say that agricultural property relief is only available on the agricultural value. So if it's got a value over and above its agricultural value, so perhaps it's away from the farm buildings, could be sold off, maybe a 5-acre paddock to a wealthy solicitor or accountant from who might fancy living in the country. It can mean it's got a market value over and above its agricultural value. So having said all that, it is potentially, if the APR isn't possible to claim it, you can still claim the 175 residence nil rate band, provided, I mentioned right at the start that if your estate, so the value of all your assets less your liabilities, if it's more than 2 million before any agricultural business property was applied, you'll lose, for every £2 over, you'll lose £1 of that 175 allowance. And once you get to 2.35 million, you lose it altogether. And again, there's ways and means around that. I won't bore you, but suffice to say, it's still potentially available.
Yeah. Thanks, Sean. Hey, Peter, do you want to come in there?
Largely endorsing that. You have a choice, I suppose. Provided your total estate, and that includes your farm, isn't over 2.7 million, you might want to use the 175 on the house to leave that 175, or if you're a married couple, 350 that you can put actually towards land. But Sean has pointed out, you need to be leaving the farmhouse to your direct. You need to be leaving the house to your direct successors actually to be able to claim residential nil rate band. So it only applies if you're giving it to your children or grandchildren. Is another important one, particularly in a farming context where maybe they're not the successor. And the farmhouse test is sort of getting harder, I suppose, at the end of the day. But certainly, this is the thing we are now scrambling around to try and find every allowance and try and stitch them all together to make the umbrella that shelters us from inheritance tax as big as we possibly can.
Yeah, thanks, Peter. Hey, Kathy, do you want to chip in there?
Yeah, just a comment, William, that it really is dependent on the house. The size of the farm, houses are getting bigger and better, and sometimes it is hard to argue that it's a typical farmhouse that's used for agricultural purposes. But as Sean had said, you will only get agricultural property relief on the agricultural value of the house. So then that's where your residence nil rate band might come in to cover the excess. But again, that's all around the £2 million test for your estate and whether you'll actually get that residence nil rate band if your house is that nice.
Yeah. Thanks, Kathy. Desi, any last words on that one from you?
No, more than well covered, William. More than well covered. It's case specific, very case specific.
Yeah. Next question, and you stay there, Desi. We'll lead off you on this one. Can we discuss entitlements and how they are handled from an inheritance tax and income tax perspective in either a succession case or a Conacre case?
So, different legs to that question.
That's a handy one for you.
Okay, so entitlements are still of value, okay, and they are principally regarded as capital assets. And while there's a clock there that's taken, it hasn't expired, and they're still tradable and traded. So if we deal with the capital gains tax aspect of it, in the first instance, then to my mind, those entitlements are capable of being transferred and gifted and held over if that's what you want to do. If you sell them, then they should come within the realms of capital gains tax, not income tax. If you lease them, it's income tax, and if you buy them in the lease, it's income tax relief. From an inheritance tax point of view, the value of the entitlement should be valued at the date of death in the same way as any other asset on the farm, and a view will be taken as to what that value is. So I think that's probably the best way of covering it.
Yeah, no, thank.
I maybe just didn't pick up every aspect of what the question was there, William, again.
Yeah. Yeah, no, I think you have covered it well there. Peter, do you want to come in on that one?
I think that has been fairly well covered. They do have a value. The only thing I would say about them as well is, for anybody who has the misfortune to be going to the Armagh meeting in the Craigavon Civic Centre tomorrow night, I have now added a slide. The other thing is, if you give away the farm, these are the sorts of things that you may need to be giving away as well. I mean, I would have concern about gift with reservation of benefit. You'll have seen me scrambling around there. You nearly got to see a solicitor's wallet because I was getting my presentation out of the memory stick on the wallet. But I mean, I have a slide here which talks about if you're giving away the farm and you're walking away, there are other things: your farm bank accounts, your business ID, your entitlements, other grants and subsidies, machinery, vehicles, crops, your livestock, your herd book, your flock book, VAT registration in the farmhouse. If you say that you're walking away, those are the sorts of things, including entitlements, that the revenue will say, well, hold on a minute. If you still have a farm business ID and you still have the entitlements for that land, you have retained the benefit from it, you're getting that income from it, we will treat you as still owning that. So not contradicting anything Des has said, actually adding to it, if you give away the land, you may have to give away the entitlements as well for that gift to be effective. Hence, I mean, genuinely, anybody, there's a couple of guys who I think heard this step talk a couple of weeks ago that are online here. You know, we have a blank sheet here. Nobody has ever had this gifts with reservation problem for agricultural property because it got 100% relief. It didn't matter. There's a blank sheet, but these are the sorts of things that if you transpose what we know from elsewhere, the revenue might say if you give away land but keep entitlements, you haven't given the land away. So there's another slightly different aspect for IHT and entitlements.
Yeah. No, thanks for that, Peter. Hey, Kathy, you want to chip in there?
From that, I think it's covered, William, on that.
Yeah, okay. Sean, are you happy?
Absolutely nothing to add there.
Yeah. Right. Hey, we'll move on then. If a farm business is in the name of a father and son as an equal partnership, but all land deeds are only in the father's name, is it better to get the son added to land deeds, or for the wife to be able to have double the allowance, or is it technically a gift land to wife? I'm mixing this up. Or would the wife be able to have double the allowance, or if technically gift the land to the wife, would this then be a gift and rent needing paid? So that's a real ramble. Peter, can you make any sense of that?
Up to a point I can. I mean, effectively they're saying if you have a son who's in the business, do you give the land to the wife so that she gets an allowance, or do you give it to the son because he's in the business? Either way, there's a specific example about this actually in the inheritance tax manual that says there's a partnership which shares profits equally and the land is owned by one partner informally occupied by the partnership rent-free. So this is this scenario. Dad owns land, dad and son are farming it together. The partner gives the land to either, in this case, it might be the other partner, the son, and the partnership continues to occupy it on the same basis. The profit sharing ratio has to be adjusted in favour of the new landowner. So dad has to give away his effectively the equivalent of rent in his profit share. If he gives the land away to his wife, he has to give the equivalent of that land rent in profit share. Ultimately, I think what we're being asked here is to see into the future. If dad gives it away and survives 7 years to his son, then that has probably worked reasonably well, provided he ticks all the boxes about gift with reservation. If he's not going to survive for 7 years, he should be giving it to his wife, but that requires a crystal ball, and that is the problem here. And that's a problem that we still have potentially, even after the budget last week, where if the landowner goes first, then we need to be able to try and cope with that and that is the problem that we're still going to have, is that, you know, I know accountants, I've heard talks from accountants where we've basically said, if you can tell us what's going to happen to your family and when, then we can map a way through that. But if we're trying to look over the horizon, we're effectively trying to give you the least worst option. So
Yeah.
if Dad survives for 7 years, great. If he doesn't, then he should have given it to his wife.
Yeah. Hey, Kathy, do you want to have a view on that one?
This is a typical situation that we would see, William, where not all assets are owned in partnership and are not owned equally in a partnership. Now, there's different ways that this can be done. You know, the father can contribute to the partnership with the son, but, you know, each of these three individuals have £1 million each, and it's just about working out what's the best way to avail of all of that. And I suppose, Peter, I don't know if you have any thoughts around, in this type scenario, the importance of a partnership agreement.
Yeah,
You know, and making sure that.
Yeah, I mean, they won't have one. It's the long and the short of it at the minute, and that's where this is going, effectively, at the end of the day. And whether something is a partnership asset or not will be determined by inland revenue returns, not by a partnership agreement in the current climate. And I mean, I've described it as being like when rugby went professional. You know, effectively, we are going from getting by without anything being written down to having to write everything down.
Thanks, Peter. Des, do you want to add anything to what's been said?
Yeah, I'll probably reinforce the point that Kathy made on the partnership piece, and probably follow on with Peter. It is really important that the partnership piece is in play, and really important that attempts are made to put that in place, just for protection. Moreover than anything else. The matrimonial piece, how you determine value, value is determined on the exit of any partner who comes in and say it fails and doesn't work. How do you determine those things? So there are questions there. The earlier part of the piece around the partnership asset, which the father doesn't have to transfer it to the son. The deeds can stay in his name, and as long as the partnership asset, as long as the farmland is represented in the partnership accounts and represented in the partnership assets and appropriately dealt with through the distribution of capital and returns, then it's fine. It'll qualify for APR. That's okay. It doesn't have to be two names. When you get into the two names or the three names, then you're about maximizing allowances. That's a different scenario. They don't need to panic about it being in one name is probably important, but you need to think about the future and how you want to utilize your reliefs.
Yeah, thanks, Des. Sean, have you
Yeah, I think that's, I echo what's been already said, that, if you are going to gift, make sure that that's reflected, that it's a gift and another partner owns it, then it's changing that profit share to make sure it is actually reflected in it. And I think what you're hearing is these changing rules is going to require far more formality around farming arrangements, because, in all parts of the UK, it's often done on very informal arrangements. But I think this change is going to necessitate that partnership agreements and the accounts reflecting exactly what's going on. It's going to need much more formality around it if you want to avoid an attack from the revenue.
Yeah. Thanks for that, Sean. We're going to move on now to a more political question, so brace yourself, Alexander. The question is, what are the odds on an incoming government reversing all these Labour taxes on inheritance? And should the Farmers Union be engaging with prospective future governments such as Reform and Conservatives? And I suppose I should say, from our union perspective, our first and main ask around all of this is that the 100% reliefs are maintained, because that basically that's a system, a pretty perfect system, and these government proposals are mucking that up. But Alexander, do you want to come in on the politics around this and what that options might be for a reversal?
Yeah, well, I suppose to say the first thing is that we have worked cross-party in Westminster, raising this at every level. And whilst obviously this is a UK farming unions campaign, we have been putting across the Northern Ireland specific case And to be fair to the opposition MPs, no matter what party they're from, I think they are largely sympathetic to where we find ourselves in, and that the Treasury has clearly, not understood the realities of farming in Northern Ireland. I suppose the difficulty in all this and our current campaign, until the finance bill is locked down, we're not really in a position to, if you like, move on to what the next stage will be. But obviously, if we have no success in the finance bill, then this will turn into a much, much longer campaign. And we will be focused on the next election, which won't take place until 2029. Now, we don't know really what happens in between times, and clearly Labour's very unstable. But I think even if the Devolve or the council elections in England next year go wrong, the Prime Minister and Chancellor, it'll be very difficult to see them surviving that. But basically, in order to trigger an early election, Labour would have to do that themselves. And looking at the current polls, that would be turkeys voting for Christmas. So they're clearly not going to do that unless something extraordinary happens. The Conservatives have stated that they want to see this policy revert back to what it was. So have Reform. The Liberal Democrats are in the same place where they want to see a much fairer policy put forward. So again, I think we are all right. I would, however, stress these are all politicians. And again, the Prime Minister said at the NFU conference, and some of us from UFU were there that day, that he wasn't going to go near this, and he's done just exactly that. So it is extremely difficult. And I suppose one other caveat I would put into the system, whilst we are putting all of the blame, if you like, at Rachel Reeves's feet, Conservative chancellors before this and Conservative politicians have stated on the record quite clearly that the Treasury have been looking to do something with APR and BPR from 2010. So, if you like, this was on the Treasury's wish list of reforms. So, whilst there are political pressures here, getting through to the Treasury in London to explain specific cases in relation to agriculture is probably our biggest barrier, because we can hold our politicians to account in elections. Holding civil servants to account is a much more trickier process.
Thanks for that, Alexander. I have one more question here. It's going to be the last question of the night, and it's back to the legalities and the economics of transfers. So the question is, can APR transfer between spouses go backwards, and how far can it go back? And does it cover spouses who are deceased? I'm struggling with that question. Hopefully it makes sense to the panel. Kathy, can you get your head around that?
Struggling slightly.
I'll read it again. Can APR transfer between spouses go backwards? And how far can it go back? And does it cover spouses who are deceased?
Des is nodding, so.
Right, well, Des, if you go with it, Des.
You're nodding, and you'll keep me right, is the way this works. But my understanding is if at this point the spouse has predeceased and never owned the land, then that allowance should be available to the surviving spouse, whoever that is, and should be able to be used. So I think really what it's saying is that from next year, then that £1 million will be available to an already deceased, transferable from an already deceased spouse.
Yeah. And are you aware of any time limit on, if like no, just if, yeah.
I think it's now going to be in from April 26th. That's my understanding of it.
Yeah, sorry, Kathy.
It was touched on earlier, William. I suppose the lack of information out there yet on this transferable allowance. As Des said, we can go back to people that have already passed, for spouses that have already passed away. But in terms of the actual detail that's out there, as to how far you can go back, what the conditions are, if there's anything else, we do really need to see the actual legislation. Sean, I don't know if you're aware of anything over and above that.
No, completely, Catherine. You're right. I think we did mention it earlier on. I think if it mirrors the sort of the normal 325,000 and the 175 against the house that can be transferred currently at the to the spouse today, then we would imagine it doesn't matter how long ago your spouse died or whether they owned agricultural property as well. But as Kathy's rightly said, we haven't got the detail on this, and this is something that I was chatting to the head of tax at the NFU about on Friday, and that's what we're seeking, that clarity now. And I think we may well have to wait until the draft legislation is available to give absolute certainty.
Thanks, Sean. Peter, where are you?
Nothing to add to that, other than to say that the clarity that we got last year took 9 months from October to July. And that would take us well beyond the actual date when this comes in this time around. But that was when we, you'll know, William, that was when we got the clarity, when the draft legislation was published, I think nearly during our July holidays here in Northern Ireland. And that was from a budget that was a month earlier. So if you can imagine what we'll be like if we don't get the detail on this until August. But certainly if it reflects just about every other transferable allowance, it should be fully transferable, and the date of death will be irrelevant. It could go back 60, 70 years.
Yeah. Thanks for that, Peter. That's the end of the question for tonight. I just want to make a very short, shameless sales pitch for the Ulster Farmers Union here. We have put an extraordinary amount of effort into this whole campaign, and every membership that we can get to support that campaign and all the other issues that are playing out in the agricultural arena at the moment, it will helps our cause, helps us make our argument, and our membership is good value for money. And I would encourage anyone, whether or not it's the last thing in the world, it's not your thing to go to a meeting, but your membership would still add force, and your membership, an increase in our membership would be noted, and it reinforces our lobbying capacity and adds just to our wheel. So with that very short sales pitch, I'm going to wind up now. And we're very indebted to John, Des, Kathy, Peter and Alexander for basically sort of sitting in the firing line and taking these questions as they come. I thought the answers and the discussion was excellent. Thank you wholeheartedly, each and every one of you, for taking part. And hopefully the folk listening in have found it useful. As we said earlier, there will be a recording of this event sent out to everyone that's registered tomorrow. So if there's a point you want to clarify in your own head, you can play it back and listen to it. I suppose the take-home message from me is all of this requires professional advice, both legal and accountancy, to sort of chart out the best path for your individual circumstances. But as I say, hopefully everyone has found it useful, and thanks once again to our panelists. And with that, a very good night to everyone. Thank you.
Thank you.